everyone. My name is Marilena and I will be your hostess for today. Together with me I have Peter, our senior market analyst at IronFX. Hello, Peter.
Hello.
Thank you for joining us today as we're looking at the fundamentals that are driving the markets currently. So, Peter, I understand that we had a strong US employment report for July on Friday. How has it affected the markets?
Well, the actual rates and figures were quite strong, as you have mentioned. Actually, we had an NFP figure which was expected to drop and actually jumped to the double amount of what was expected. It surpassed 500K. At the same time, we had an unemployment rate which ticked down from 3.6 to 3.5%. And we had also the average earnings growth rate, which was expected to slow down just a bit. It did not. It remained unchanged at 5%. So overall, we may say that on the one hand, we have a US employment market which has tightened even further, given the tick down of the unemployment rate. It still has a wide ability to create new jobs. So that shows us a depth in the tight US employment market. And it's expected to continue to feed inflationary pressures within the US economy, given that the average earnings remained rather strong. We have to note here that we had a US dollar which strengthened substantially against other currencies on Friday afternoon. At the same time, we may have seen US stock markets more or less dwindling on whether to drop or not. They dropped a bit, corrected a little bit higher later on. So we had some mixed reactions at the close of the US session on Friday. And I would like to note that gold's price dropped a little bit, practically reflecting the strengthening of the US dollar, yet not to the same extent. We would note, though, that also at the same time as the US employment report, we also had Canada's employment data for the same month, July, and there things were not that good. Actually, we had an employment change figure which more or less failed to get out of the negatives and had another contraction. And overall, that tended to disappoint cut traders. It could affect partially also BOC's hiking path in the coming meetings.
And what earning reports would you highlight for today?
Well, we have a number of earnings reports. However, I would dare to say that the vast majority of high-profile companies have already delivered their earnings reports. For today, I would note practically SoftBank, AIG, and Novavax from the pharmaceuticals. Would be quite interesting. I would also be noting during the week Disney and Kodak.
Nice. What's on the calendar for the day?
Well, we have a pretty easy calendar today, so we would expect fundamentals to take over. Nevertheless, I would note for Eurozone, the forward-looking Sendix index, that's for August. Now, the indicator's reading is expected to improve somewhat, yet remain in the negatives. Should that be the case, we may see its impact being moderated to low, given that there is no substantial improvement in the sentiment for the Eurozone.
What about the monetary front?
We don't have actually any substantial speakers for today, but I would note that we had in the past few days Fed Governor Bowman, Michelle Bowman, and she more or less reaffirmed the Fed's hawkish intentions. Governor Bowman practically stated that she's open to the size of the next rate hikes. And that would allow practically for the Fed to maintain a 75 basis points rate hike, as could also the release of the US employment report. Don't forget that we had already rather strong PCE. We had also a strong US employment report. So up until now, things are implying that the Fed should continue hiking rates at a considerable amount.
And what about the rest of the week?
I would be highlighting practically two events, but let me make a start with Sunday's Chinese trade data. We had China's trade data for July, and we had a rise, a substantial rise of the trade surplus. At the same time, we had also a slowdown of the import growth rate. And that allowed practically the trade balance, the trade surplus to jump. It was quite positive for the Chinese economy, given that it's strongly export-oriented. On the other hand, though, that would be not so good news for Australian exporters of raw materials, given that most of Australian raw materials are being directed to China. I would be highlighting in the coming days practically two releases. The first would be the US CPI rates, which is also the next big test for the US dollar. Now, the CPI rates are expected to slow down both on a month-on-month as well as on a year-on-year level. And should that be the case, we may see analysts implying that the inflationary pressures in the US economy have peaked and about to start slowing down, which may ease the pressure somewhat on the Fed to continue hiking rates. On the other hand, on Friday, I would also note from the UK the GDP rates. They are for June and quarter two. Both are expected to drop into the negatives. And if actually so, we may see the pound relenting some ground, as that would reaffirm the grim expectations on behalf of Bank of England as they were expressed in its last interest rate decision on Thursday, as the UK economy is entering along a prolonged, if you prefer, recession.
Any final comments, Peter?
Well, I would like still to see whether we are going to be experiencing any aftershocks in today's American session. Albeit we have to note here that US stock markets more or less showed their reaction during Friday's session. Other than that, we will have to see also whether there's going to be a more risk-oriented approach by traders and market participants, which could provide the necessary support for the US stock markets.
Great, Peter. Thank you for your time. And everyone for watching. Join us after a short break for technical analysis with Peter Iosif.
So welcome to the technical analysis part of the presentation. In front of your screens you have the 4-hour chart of the USD index. In general, any charts we show will be of the time frame of 4 hours unless otherwise stated. Now we note the wide jump of the USD index on Friday afternoon, which was signaled practically by the release of the US employment report for July. And the index seems to remain currently in the spectrum between the 105.90 and the 107.20 resistance line. Let me readjust this. Now, given that the price action seems to be marking higher highs and higher truths, slightly higher truths, we may see practically the index being on the rise and possibly breaking above the 107.20 resistance line, starting to aim for the 109.10. Other than that, I would be noting also the possibility that the pair has started to stabilize between the pre-mentioned levels, as it seems to be finding some difficulty in marking higher highs. Note how the price action has been in this range practically since the 19th of July. On the other hand, the bullish tendencies could become more obvious if we drill down to the daily chart. Here we go. This is only the price action for the past 4 days, 5 days since Monday last week. It's a big question whether the price action is going to be stabilizing or whether it's going to continue its ascent higher, breaking the 107.20. Should the bulls actually take over, I would expect the price action, give me a sec, here it is, to break the 107.20 resistance line and start aiming for the 109.10 resistance level, which provided some resistance around the 14th of July. Higher than that, we have also the 111 resistance barrier. Yeah. Drilling back to the forward chart. Here we go. On the flip side, and should the bears take over, I would expect the price action to break the 105.90, break the pre-mentioned upward trend line, and aim, if not breach, the 103.45 support level. Lower than that, we also note the 101.25. Note how valid the 103.45 is, as it provided support here, while the S3 was valid here. Let's now flip to Euro USD. Excuse me, Euro USD, which maintained its sideways motion between the 1.0275 resistance line and the 1.0110 support line. We tend to maintain our bias for sideways motion of the pair as long as it remains between the pre-mentioned levels. Practically, traders could buy on the highs and sell on the lows. Sorry, sell on the highs and buy on the lows. Overall, I would note that the Rsi Indicator seems to remain close to the reading of 50, just below it. Yet that seems to resemble more of a sideways movement once again. Should the pair find extensive buying orders along its path, we may see it breaking the 1.0275 resistance line and start aiming for the 1.0380 resistance level. Mind you that there is a downward trend line, a wide downward trend line, which had its beginnings around the 10th of February. This is the daily chart we're looking at right now, and that could be put to a test in the next couple of days if it's being extended. Nevertheless, for the time being, we maintain our bias for a sideways movement, yet some bearish tendencies may exist. Should the bears actually take over, we may see the price action dropping, breaking the 1.0110, and start aiming for parallel level again, which was tested practically around the 12th to the 14th of July. On the upside, we have mentioned once again the possibility of the pair breaking the 1.0275 resistance line, breaking the downward trend line, and start actively aiming for the 1.0380 resistance line, which used to be a support line back here that would be around the end of June, beginning of July. While even higher, we note the 1.0485 resistance level. Let's have a look now at cable. This would be cable's 4-hour chart. Now there is a downward motion which we have to take notice of. Let me make the necessary adjustments. We haven't visited this pair for a period now. There we go. Now, the pair has dropped on Friday as the US dollar strengthened, yet recovered some ground during the late American and today's Asian session, as well as today's early European session. But as long as it remains below the downward trend line, despite some stabilization here, we tend to maintain our bias for bearish movement, which would drive cable lower, breaking the 1.2070 and start aiming for the 1.1935. Should even the S2 be broken, which provided, by the way, support here, here, and here, and resistance here, we note the S3, the 1.1760 support level, which is also the lowest level of the price action in our chart, and provided substantial support around the 14th of July. On the flip side, should the pair stabilize, we would expect the stabilization to be between the 1.2070 and the 1.2185, and it could be signaled practically by the breaking of the downward trend line, which was incepted since the pair peaked around the 1st of August. Most probably we may see some price action rising slightly, breaking the mentioned downward trend line. That would be a prerequisite. That would be the first signal of the price action, which would be ringing the bell for a changing trend, and stabilize between the 1.2185 and the 1.2070. Should the bulls take over, the bulls definitely we would see a breaking of the mentioned downward trend line, yet for the bullish scenario would require also a clear breaking of the 1.2185 and the pair to start aiming for the 1.2330 resistance level, which provided resistance around the 27th of June. Higher than that, we also note the 1.2480 resistance barrier. Note the Rsi Indicator, which is slightly below the reading of 50 and could generate some bearish tendencies. In such a case, we may see the Rsi dropping and starting to aim for the reading of 30. It's quite an interesting chart here, and it's quite interesting to see whether the price action will actually follow the downward trend line, break the 1.2070 and start actively aiming for the 1.1935. Mind you that for a bearish scenario, I would require, besides the breaking of the besides the following of the pre-mentioned downward trend line, also the next show to be lower than this point here, which would be the 1.2002 to be exact. So we may see it dropping below the 1.2002 here and start actively aiming for the 1.1935. That would be the level for the bears here, this area. Or if you prefer, the next target area for the bears. Let's have a look at USD/JPY. USD/JPY, which has been on the rise. That's nice. Okay. It's nice to see how the pair bounced on this upward trend line practically on Friday, but before the release of the US employment report for July. That will be around the Asian session. Nevertheless, the rise during the American, just before the American session started, was characteristic after the release of the US employment report for July, and as was also the breaking of the 134.70 resistance line, which now has been to be turned to a support line. Let's make the necessary corrections here. Trading the 134.70 to a support line and raising. Let's go hunting for a new ultimate resistance level, if there is one. Okay, there's none. Daily chart. I'm going to be placing the next resistance line at 142, and Actually, it could be a little bit lower. $41. Let's place this in red. Given that the price action's upward motion has been slowed down, let's drill back down to the forward chart, zoom out, magnify, readjust. Let's start placing the labels. Ultimate support line being placed now at 131.50. Actually, I would like to widen this. Place it here. And this would be the 130.60. Sorry, 130.35. $133.15. Support line being placed at 134.70. First resistance line to be placed at 136.75. Second resistance line to be placed at 139.35. And the final resistance line to be placed at 141. This could be corrected also a little bit lower. Somewhere here. That would be the 132.75. Yeah, that should be about it. Other than that, now we tend to maintain a bullish outlook for USD JPY as long as it remains above the upward trend line, which has incepted since the 2nd of August. It seems to be guiding the pair upwards. Note the touches here and here. The fact that it rises and marks higher truths and higher peaks, that tends to imply both a bullish movement, which could correct a little bit lower. That should not be strange, yet most probably will continue higher, possibly testing, if not breaking, the 136.75 resistance line. Also note that the Rsi Indicator, despite below our 4-hour chart, despite correcting a little bit slightly lower, still remains well above the reading of 50, once again implying rather bullish sentiment. On the other hand, should the pair stabilize, we may see it revolving around the 134.70 resistance line, support line. While should a clear downward trend line take over, we may see the price action breaking the 134.70 support line, breaking the prementioned upward trend line, and start actively aiming for the 132.75. In general, the breaking of the upward trend line becomes key for any trend reversal. Okay, let's have a look now at USD CAD. USD CAD, which rose, yet seems to have respected the 1.2945 resistance line. And it seems to be also on its way to correct lower. So we tend to maintain a bias for sideways motion between the 1.2945 and the 1.2780 for now. Yet we wouldn't be surprised to see the bulls take over, given also that the pair seems to be marking higher lows, higher highs, and we may see it reversing, breaking the 1.2945, which would be a first signal for a trend reversal to the upside, and start aiming for the 1.3075 resistance level. Higher than that, we also note the 1.3220 resistance level, which has practically capped the upward motion of the pair, and that would be around the, let's have a look, 14th of July. On the other hand, note how strong the R2 is, given that it has provided twice here resistance, effective resistance, around the 6th of July. To the downside, and should the best take over, we may see the price action dropping, breaking the 1.2780 support line, which provided support around the 1st of August, noted here, and start aiming for the 1.2685, while even lower we note the 1.2520. Let's have a look where exactly these two levels have found the support, where are the touches. Okay, the S2 used to be a resistance line, and given that the price action has risen above the 1.2685 level, it has now switched its role to support line, while note how beautifully the 1.2520 has provided support for the pair, and that would be around the early days of June, around the 7th to the 8th of June. So they're still valid, we're keeping them. Let's have a look now at the other commodity currency, that would be the Aussie. Aussie, which has been on the rise substantially. Note that AUD USD dropped in the American session on Friday with the release of the US employment report for July, which would be expected. That's not something which should surprise us given the strong data which were released. But during the late American session corrected higher, that was on Friday, and during today's Asian session corrected even higher, and during today's early European session reached the levels it was before the release. I think we would have a more clear picture if we drill down to the 1 hour chart. Here it is. It's actually exactly where it was before the release of the US employment report on Friday. So we tend to maintain a bias for a sideways motion for the pair, given that it has tested the 0.6980 resistance line. Despite breaking it, we still consider it as a valid level, given that it had provided support once, twice, 3, 4 times, 5 times here, and resistance back here. So a sideways motion between the 0.6980 and the 0.6915 for the time being seems to remain our best scenario. Note that the Rsi indicator below the 4-hour chart has reached, even slightly surpassed the reading of 50, stabilizing somewhat, and that would be also quite interesting. On the flip side, moving to the upside, should the bulls take over, we may see AUD USD rising, breaking the 0.6980 and start aiming for the 0.7045. Note how it provided the resistance here. There was a continuous upward motion which peaked at 0.7045 resistance level. Even higher, we note the 0.7135. To the downside, and should the bears take over, we may see the price action breaking the 0.6915 support line. I mentioned the support levels provided here, and here as a resistance, and start aiming for 0.6860, which provided support here and resistance here and here, also support here and here. So I wouldn't be surprised to see it breaking the 0.6915 in the case of bearish outlook, testing the 0.6860, bouncing back up. Even lower, we note the 0.68, which would be practically a level formed by the support provided here and here. Let's have a look now at safe haven USD/CHF. Also in a sideways movement. USD/CHF, which has remained rather stable between the 0.9640 and the 0.9550. We tend to maintain a bias for that motion, that sideways motion, given also that the Rsi indicator has dropped and reached the level of 50, implying a rather indecisive market. Should nevertheless the pair find extensive buying orders along its path, we may see the price action rising, breaking the 0.9640. That would be the first signal of a trend reversal, and start aiming for 0.9730 resistance level. Note how it has provided resistance around here. That would be from the 20th to the 22nd of July. In case the R2 now is broken, we may see the price action of USD/CHF aiming for the 0.9860 resistance barrier, which is also practically the highest level in our chart, maybe with this false break here being an exception, but the level has provided considerable resistance, and that would be on the 12th of July and once again on the 14th of July. On the 12th of July, it was characteristic that it has marked the peak of a long upward motion which had started practically from the 29th of June and lasted up until the 12th of July. That was for 2 weeks, and it was stopped at 98.60. In the case of a bearish outlook, we may see the price action breaking the 0.9550 and start actively aiming for 0.9455, while even lower we note the 0.9375. NZD USD, also in a sideways motion between the 0.6290 and the 0.62 level. We tend to maintain this bias for sideways motion for the pair, and we tend also to expect that, given the upward motion of the Rsi indicator reaching the level of 50, some stabilization could occur. Should the bulls take over, I wouldn't be surprised to see the price action breaking above the 0.6290, which would be a signal for a trend reversal from a sideways movement for a bullish outlook. Mind you, the middle level around 0.6350, while even higher for NZD/USD we note the 0.6390 resistance level. As an ultimate target for the Kiwi, we note the 0.65 resistance barrier. To the downside, and should the bears take over, we may see the price action breaking the 0.62 and start aiming for the 0.6095. Now we're going to be abandoning the FX market. Let's have a look at precious metals. I see you have requested gold, XAU USD. Oh, that's a nice one. Now we have an interesting chart. Let's make a start by clearing this up and readjusting the levels. Now the R1, in my opinion, remains at 1793. The R2 at 1813 is also valid, given it has provided the resistance here, while even higher we note the 1845. Once again we see a sideways motion. On the other hand, we had a colleague of mine in today's morning presentation showed me this. It's a big question. On the one hand, we have higher truths which are being formed and higher peaks which do suggest a clear upward motion, given that we have also an upward trend line. In such a case, I would expect the price action of the precious metal to rise, breaking the 1793 resistance line and start aiming for the 1813. On the other hand though, we see that the Rsi indicator below the 4-hour chart is quite flat. Let me add it. And it's just running along the reading of 50, implying rather indecisive market. Now we see the case here for two main scenarios to play out. The first would be for the precious metal to stabilize, and should that be the case, most probably it would be between the 1793 and the 1763. Could be even a little bit lower, possibly somewhere here. 60. Let me correct the label as well. I just wanted to include also this motion here. We can see how it provided support a couple of times. On the other hand, should the bulls take over, once again we would expect it to break the 1793 and start aiming for the 1813, while in an extreme bullish scenario we would note the 1845. In a bearish scenario we would expect A, the price action to break the upward trend line, signaling definitely a trend reversal, and for a bearish scenario we would also expect the price action of gold to drop below the 1760. I would like to see it dropping below these troughs here and start actively aiming for the 1740. Even lower we note the 1715 support level. Once again, for the time being we maintain a bullish outlook as long as the price action respects the upward trend line which was incepted since the 21st of July. Let's have a look at WTI and then we move to US stock markets. Now WTI has dropped, interestingly enough, and it has remained below the reading of 30. And despite the stabilization, I still maintain a bearish outlook. Yeah. However, before we move on, given that the price action of the commodity has broken the 92.60, let's switch this from a support line being a resistance line. Let's go hunting for another support line. Now this seems like an interesting level. Note the touches here, and it was aimed for a test here as well. It could go a little bit lower here as well. Nah, here. I'm keeping this one, and that would be in greens. It's 77.35. Let's readjust. Let's correct the labels. $106.30 being the ultimate bullish target. 100.65 second resistance line. 92.60 being the first resistance line. 87.20 being the first support line. 82.60 the second, and the final support line being placed at 77.35. Now, let's analyze the picture we have in front of us. WTI's price action has dropped, and in my opinion, the first initial key element would be the fact that the price action has broken below the reading of 92.60, which used to be the lower boundary of its past sideways movement. So it signaled that it has exited the sideways movement. It was a clear break to the downwards, and seems to be currently finding some support. Actually, since the 4th of August, seems to be finding some support around the 87.20 support line. Even lower, we note the 82.60 support level, and even lower than that, as a support barrier, we note the 77.35 support line. I would note though the fact that the price action remained below the reading of 90, which provided some support here, but still is a bearish signal for me. Also the fact that the downward trend line has started to form despite the stabilization here, it's still implying some bearish tendencies. And the last bearish signal, in my opinion, would be the Rsi Indicator below the 4-hour chart, which at some time tried to correct higher, but it failed to do so, and it's currently aiming for the reading of 30 once again. All of that on a technical level tends to predispose me that we may see the bears continuing to dominate the commodities price, in which case we may see the price action of WTI breaking the 87.20 support line and start aiming for the 82.60 support level. Even lower, we note the 77.35. In case of a stabilization, I would expect the price action to remain between the 87.20 and the 92.60. I would require clear breaking of the downward trend line, which would be signaling the stabilization of the pair and the trend reversal. For a bullish outlook, I would require more than mere breaking of the downward trend line. I would expect the commodities price action to break the downward trend line, break also though the 92.60 resistance line, and start aiming for the 100.65 resistance level. Nothing less. Nothing less will bring my confidence for the bulls back. Okay, let's have a look now, a quick look at US stock markets. Let's start with Dow Jones. Dow Jones, which remained at rather high levels despite the correction lower in the American session on Friday due to the release of the US employment report. Let's readjust the levels. So the sideways motion is being continued. We may be seeing here also another mid-level. Let me show you. Somewhere here. But that remains to be seen. For the time being, we tend to maintain a bias for a sideways motion. We have mentioned that. And should the bulls take over, I would expect nothing less than the price action to break the 32,900 and start actively aiming for the 33,470. I would require a series of higher highs and higher lows before calling in the bulls. On the other hand, should the bears take over, we may see the price action reversing direction, breaking the middle level at 32,380, and I would require also breaking of the 31,955 support line. Even lower, we note the 31,445, while even lower the 30,440. For the time being though, yes, it's noted correctly by you guys that the Rsi indicator has been on the rise and seems to be aiming for a reading of 17. We can see a similar picture also with S&P 500. And Nasdaq, albeit Nasdaq had a wider drop in the American session on Friday. We have to correct this level here. It has been broken. In general, it would be nice to readjust them once again. That should sum it up from all of us here at IronFX. Best wishes for solid trading.
Once you have chosen your preferred trading instrument, the next thing will be to set up a plan. You will need to do a technical and fundamental analysis to understand the circumstances surrounding your trading, and then decide at what moment you enter the market, on what direction and which volume you are setting your trade. Also, you will have to define at which price you enter and at which you exit the market. There is no such thing as the perfect entry and exit. Stick only to the entry and exit parameters in your plan. Harness the technology available. Set automatic stop loss and take profit orders. Try to set the emotions of greed and fear under control, but have no misconception and emotionless trading cannot endure, so be conscious about your trading. Maintain discipline and your bottom line will thank you for it the long run. I can tell you, I see so many people on YouTube, on blogs, on social media trying to make videos to show people how to trade. The first thing you need to know about trading is that it has to express your uniqueness. The best traders in the world are the best because they know who they are original, they are confident in their ideas, and they're more than confident to display their uniqueness through their trading.
Okay, all right. So let me begin today's session. Today's session is on top trend indicators. Okay, it's there are a lot of ways to trade trends, right? There are a lot of ways to trade trends out there, and it's one of the most profitable trading strategies. When you're trading trends, there are two things you can do. Let me see. I can pull out my my pen over here. When you're trading trends, there are two things you can do, right? You can, when there's a trend, you can either continue to play the trend, right? Or you can, so this is one way, you're playing the bounces, you're playing the bounce, you're playing the bounces over here. So this is one way that you can trade, to make money. Hey, Natalia, nice to see you tune in. And there's another way of trading trend, which is, when there's a trend, you play the breakout over here, right? So there are essentially two ways to trading the trend. Both are equally profitable, but it's very tricky. Many times we think that we're going to play a breakout, then it comes down, then it comes back up here, right? It comes back up here, so you end up losing money, right? So sometimes we think that we want to play the bounce, then it end up breaking out, and we end up losing money. So there are many times when this happens, right? And we need to ask ourselves, right? How do we reduce the chances of that happening? Yeah, right. How do we reduce the chances of that happening? How do we reduce the chances we get freaked out here? When we think it's going to bounce, then it breaks out. Or in this case, where I think it's going to break out, then it bounces, right? So how do we avoid that happening, right? So in today's webinar, right, I'll be showing you some of the ways that I've done it myself, right? And to really increase the probability of my my trend trades working out nicely. Okay. Now, guys, if you're here, what I'd like to encourage you guys to do is there's a chat panel that's open, where I can see a couple of people sending messages through, right? Feel free to send your messages in there. I'm going to send my message one more time. Hi, right? So send your messages in there. So I literally have another screen open on my left, right? That is monitoring these questions. So if you have questions, just send it through. I'll do my best to get to them, right? Don't wait until the end of the webinar. We might not have time to answer these questions. Anytime you encounter anything in the webinar where you're not sure about, just let me know. I'll do my best to answer them. Okay. And of course, feel free to send any messages in there. Even if you want to chat with me, right? Go ahead, right? Because otherwise you feel like I'm talking to myself, which is very sad. Right? It feels like I'm going to talk to myself, right? So yeah, it'd be nice to see you guys. Hearing a little bit of stuff from you guys. Maybe for starters, if you can let me know which countries are you guys tuning in from, right? Which countries are you guys tuning in from? Because in Singapore now it is 6 p.m. right? It's 6 p.m. here, so I'm just wondering where you guys are tuning in from. Oh, Kurt from UK. So UK is about, what is it, like 9 a.m. there? Oh no, it's about 10 a.m. there now or something, right? Now, I always liked the idea of going to 11 a.m. right? I always thought people who live in UK, they're so lucky. They get to watch the English Premier League. Anytime they want to watch Manchester United, they want to watch Chelsea, Liverpool. They can just the idea that can watch like the matches there, just so great, man. In Singapore, we hardly have any like football worth watching. Hey, Joshua from Nigeria, good stuff, man. Good stuff. Hope to visit there one day. right? Anyway, guys, I can see a couple more of you guys slowly streaming in. Nice to see you guys here. Right, let's begin today's session now. Remember, disclaimer. Everything in this webinar is educational in nature, so nothing should be construed as investment or trading advice. Please do your own little due diligence before you guys trade, okay? Oh, someone in Singapore, right? Singapore, I'm not sure if you in your 7 hours stopover, did you manage to check out the Jewel, right? We Singapore has this thing called the Jewel. Is right in the airport. It's a huge place, right? Let me see. A Singapore Jewel. Not Jewel, not jewelry, right? It's actually just Jewel. Yeah, Singapore has this place. It's called Jewel, right? This is literally in the airport, right? You can see like there's the airport around here. It's this massive dome. It's called the Jewel, right? So if you ever stop by in Singapore, do check it out. It's a really awesome place. I think we have the world's largest artificial waterfall over here, right? So yeah, it'd be good if you guys stop over. Let me know, right? We can catch up for a meal or something. Ishmael, nice to see you tune in too. Good stuff, man. Thanks for tuning in nice and early. Let's begin today's session. All right. So anyway, those of you guys who are here for the first time, a quick introduction to myself. My name is Butterfly House. Yeah. All right. So anyway, my name is Desmond. I run the award-winning research firm Everest Fortune Group and also the Forex Army. Right. We are finalists for Best FX and Best Equity Research 2019, 2020, 2021. Right, so I run a strong team of prop traders, right? We usually work with the major financial institutions, telling them where the markets are heading. But we have a special partnership with IronFX where we're bringing guys the good stuff, the juicy stuff, the stuff that'll take your trading to the next level, right? So in today's session, it'll be a fun time. I'll be showing you how the pros use the different trend indicators out there as a confirmation, better ways to improve the probability of playing the bounce or playing the breakout. Okay, now let's begin today's session. Okay, now the agenda for today, I'm going to show you, I'm going to talk a little bit about trend indicators, right? We're going to look at the 5 most effective trend indicators. I'll talk about implementing it into a strategy. How do you play the breakouts? How do you play the breakouts and how do you play the bounce? The reversals rather, right? So just so that we're on the same page, breakouts are when prices breaks out of a certain level. Right, bounces is when price bounces up from here, right? So there are 2 ways to play trends. One is you go with the trend is your friend. The other is you play the breakout from the trend. Okay, so these are these are important things that we can do. We'll be exploring today, right? So on to the first introduction to trend indicators, right? So there are many trend indicators out there. Right, all of them kind of one way or another, right? There's stuff like the Ichimoku Cloud, we call it IKH. There's some moving average indicators. There's stuff like even the MACD. MACD actually measures once it crosses the signal line in the middle, right? That's where it's a little bit picking up of momentum, right? There is a stuff like, for example, a moving average crossovers, right? There is the ADX. Right, ADX, very useful indicator if you know how to use it correctly. ADX, you can use it. It measures the strength of a trend, but it's usually a little bit slow. It's a little bit it's a little bit slow when it comes to using the ADX in measuring trends. So I'll be showing you one of my handy dandy what's the word for it? Handy dandy indicators, trend indicators I use that have worked out pretty nicely in the past. Right, and I still use it up to today. Okay, now a few important links that I want to point you guys to before we begin. Right, IronFX.com. You want to go to for the upcoming webinars. You want to go to you just need to wait for the drop down to appear. IronFX School. Right, you want to go to webinars. Right, so under webinars, this is where you get to see all the upcoming webinars. What you can do is you can click on English, right? They can see, right, these are introduction to trend indicators. Tomorrow's a live trading session. Me or Cassandra would be taking it, so go check it out. All right, we got advanced moving average strategies next week. If you want, please go register for it. I'm just going to copy the link here and send it to you guys. Right, go register when you have the chance. Okay, this is advanced moving average strategies. Will be an expansion of what we're doing today. Right, but it's a really great way I'm going to show you how to use moving average. Pretty fun in a pretty nice manner. Oh, cool! The webinar is live now. Right, so this is the first thing you can go place. The first place you can go to. Second is these past webinars, right? Past webinars, great place for you to catch up, right? This is me, Cassandra. A couple of new people coming in, right? This is where you can watch, like you click on English, you can watch all the previous webinars we did, fundamental, technical, support and resistance, right? Great place for you to learn all the previous stuff we talked about, okay? So go check it out over there. Now, let's begin today's session, okay? Give me a second. Sometimes I talk too much and my throat hurts. All right, so let's go. The first thing is the Ichimoku Cloud, right? The Ichimoku Cloud is one of the best indicators when it comes to trend. Now, there are two kinds of, let me see if I can pull it out over here. There are two kinds of, when you use the traditional Ichimoku Cloud indicator, right? I'm going to show it to you over here. Usually, when you use an Ichimoku Cloud indicator, it comes like this. This is how it looks like, right? And this can be quite overwhelming. If you look at it, right, there is the leading, the Chico span, right? The the leading span, all the different kind of like basically conversion-based lagging, leading A, leading B, right? So there are all these kind of different lines, and it can be a little bit overwhelming when you look at the Ichimoku this way. So a lot of people, when they try to use Ichimoku, what they don't like about the Ichimoku is that because of all these lines, it makes the chart over cluttered, right? It makes the chart over cluttered. So what you can do instead, right? What you can do instead is actually you can click on this setting, remove everything, and just leave the background. Leave the background as it is, and this is good enough, right? This is good enough for trading simple trends. Right, you notice how it works very well when price tends to be trending in an area. You can see how price tends to respect this area. When it breaks this area, it kind of goes down. Right, when it breaks this area, it goes up. It failed to break this area, come down. Failed to break this area. So price does respect the Ichimoku in some ways. Right, it doesn't work that well if it is like in a ranging market. Right, but when it starts to trend, you can see how crossing below, you could catch a very, very nice trend all the way down. Of course, how do you get out at the bottom? How do you get out at the top? This is a topic for another day, right? But you can see that the Ichimoku can be used as the Ichimoku Cloud, right? Over here, it can be used as a great way to trade the trend, but you cannot use it by itself. Okay, you cannot use it by itself. Ichimoku is weak when the cloud is small. Look at the cloud over here. It's small. It's small. It's small. It's small. It's not that great. It's very thin. Right, so if the cloud is too small, it's not that strong. You think about it, when it's raining, right? When it's raining, if you have a huge cloud up there, you got a lot of rain, right? But if you have like small little clouds in the sky, right? It's not that great, right? It might not even rain. So when there's a big cloud over here, that's where you can see price tends to work very well. Even when there are big clouds, now this is a trick, right? There's big clouds on here, big clouds on here, but if price tends to cut right through the two clouds, right, this is actually a trick that sometimes people don't realize, right? They're like, oh, there are big clouds over here, but they don't realize that price can sometimes just cut right through the clouds. Imagine you are you're Superman over here, you're flying, right? You fly through the clouds, right? When you fly through the clouds, then you don't get wet with whatever clouds are over here. Right, so that's a trick when it comes to Ichimoku. Just because there might be a big cloud over here and a big cloud over here, right? If you actually cut through the weak point, right, that's actually a one way to break through the resistance or support, right? One consideration for you guys to take note of. When they get caught in a cloud, it tends, you could see stuff like that where price is fighting and caught within the cloud, right? So the Ichimoku is a great supporting argument. Right, the key word here is supporting. It is not a trigger. It is a supporting argument. right? That means it is used to complement your trading analysis. It's never used as a trigger to enter your analysis because the Ichimoku is still a little bit lagging, right? It's not it's not as accurate as some of the other stuff which I'll be showing you in a bit. It's more used as a lagging indicator, right? As supporting argument, okay, a supporting argument. All right, so yeah, this the first thing I want to show you is Ichimoku. I guess we can scroll back a bit and we can see like how the Ichimoku performs. You notice that in times where it's ranging, right, it really doesn't perform very well, right? You know, you can cross below, cross on top, cross below, cross on top, cross on top. But yeah, once it breaks the key level, right, and that's where it could open a bigger move down. Just looking at Ichimoku Cloud will help you trade better, right? Of course, the key thing here is that don't just use it as your main form of trading, okay? Don't just use it as your main form of trading. Let me just see if I can draw an example over here. I do have some examples drawn out, right? I have some examples drawn out. I'll see how I can show it to you in a bit, right? I know we do have some examples here. Very nice channel break. Could be. Never mind, right? I prepared some for us to go through, right? So anyway, the Ichimoku Cloud is one of it. Let me show you the next thing, right? The next thing is the golden and death cross, right? The golden and death cross. They are actually called the 250 SMA crosses. So this is when the 50 moving average here is the goal line, and the 200 moving average is the black line, right? So when this happens, right, when the 50 crosses below the 200, this is what we call a death cross. So usually when this happens, right, actually it's the start of prices kind of going down, right? And when a 50 moving average crosses above the 200 moving average, this is where you call it a golden cross, right? And that usually speaks to the start of a very nice uptrend. Now, there are ways for you to get out of a trade before this happens, because most people who trade the golden and death cross, one of the problems is that when you imagine when the cross happens here, you get in here. If you wait for the cross to happen over here, which is over here, look at how much of the trade you have given away, right? You got in over here, right, which is about over here, right? You end up making this much. Maybe if you're lucky, you make this much money, which is crap, right? It's not that much, right? So there are actually other ways where you can get out of the trade. If you got it, you could actually have caught all the trade all the way down. This would have been your maximum potential. This, you could have made this much instead of this much over here, right? So how do you get out of a trade before, like maximize the most out of a golden death cross? I'll be showing you guys how to do it in a bit. Okay, now golden and death cross, right? How we can actually look at some of the golden and death crosses here. So I have an indicator that just loads the MA 50-200. You can see it kind of works out well most of the time, right? So there are the downside of this is there are false signals, right? You could have something like this, when you have a death cross, you think it's going down, it goes up, it cuts you out, right? And then it goes down another time. But if the one time you do catch it, right, it goes all the way down very nicely over here, right? You can see go down. It's a nice big move you're catching, right? It's a nice big move you're catching. There are other times where, cross up, by the time you think you're going up, it starts to cross down over here, So this part is where this is the problem with, this is the kryptonite of the moving average crossover, is that in a rangy market, it will completely, wipe you out. But if you catch it at a good time, like this, you can write a massive move down, right? All the way until it gets out, maybe over here, right? Most of the time, each time you get one massive trade like that, you might get multiple trades where you get wiped out once, wiped out multiple times, right? So this is an important, how do you avoid stuff like that? How do you avoid stuff like that is part of what we'll be covering today, right? It's what I call indicator confluence, right? Using multiple things to really to really improve the accuracy of your trend lines breakouts. Okay. Next thing I do want to teach you guys, right? I'll be showing you guys right now on top of the golden and death cross, which uses the 250 moving average, is the price times moving average crossover. So I know it sounds quite simple, right? Price, as you can see over here, crossing over the moving average very nicely. Then it goes on a nice little journey all the way up, all the way up, all the way up, as you can see over here. This doesn't happen all the time, but it happens enough, right? Moving average crossover, you take a trade, it goes all the way up, right? So this is one of the nicer, very simple, and it's oversimplistic, right? So this is where I'm going to show you guys another method, which is called the before this, right? Before the natural moving average, another very, very nice indicator that we use are channels, right? The key thing to focus about channels is that you need 4 touches, right? You need 1 touch, you need 2 touch at the bottom minimally, and you need 2 touches at the top. Or you can consider this another touch, right? So only when you have 1, 2, 3, 4 touches, then it becomes a channel. 5 touches is still a channel, and this is where you can kind of play the bounce, right? So what have we covered so far, right? Now I'm going to show you how it all comes into play later when we combine them together, right? But you can see we have the Ichimoku Cloud over here. That's number 1. Golden and death cross number 2, right? Price times moving average cross over 3, right? We got channels number 4. The fifth one, the fifth thing that I wanted to teach you guys is actually the natural moving average. This is actually one of the key parts of what we're going to cover today, right? Because it's a concept which very few people know about, and very few people know about. All right. Now, in this example, which looks better, A or B? Right. This is a moving average from A. This is a moving average from B. Which looks better? Do you guys want to try to just put in your answers a bit? Kurt, I'll answer your question in a bit, right? Does anyone want to take a guess which looks better, A or B, when you're looking at the moving average? I see some people answering privately to the panelists, right? Some people are saying that A looks better, right? A looks better than B. Right, here we got Kurt saying that A looks better. Okay, most people are saying that A looks better, right? Actually, I got a couple of answers coming in saying that A looks better. Okay, so A looks better, right? You think about it, look at it over here. Bounce nicely once, bounce nicely twice, bounce 3 times, 4 times, 5 times. When price breaks this moving average, it goes down, right? This one it catches once, it misses it by a bit, as you can see, misses it by a bit, as you can see. It catches 2, catches 3 times, and it reverses from there, right? In fact, this one catches the reversal slightly better than this one, right? So we can agree that A is better than B. A is better than B, okay? Now, let's take a look over here, right? So this happens to be the 46 SMA, and this is the 50 SMA. That is an interesting thing. This is a 46 moving average, and this is a 50 moving average. Most people, when they trade, they use a 50 moving average without a second thought, right? They're like, all right, I'm going to put a 50 moving average in there, right? And yeah, they use it to trade. They don't realize that all they need to do is to tweak their moving average just by a bit, right? And you're able to get a much better kind of a moving average that catches more of the bounces. More of the bounces, and probably gives you a better indication of a breakout, right? So this is what we call the natural moving average. Because if you think about it, no one has ever said that the market obeys a 50 moving average, or a 100 moving average, or a 200 moving average, right? No one ever said that. Those are just numbers that people throw out there, right, for the sake of convenience, right? What's a 50, what's a 100, what's a 200 moving average? No one ever said the market will explicitly obey that moving average, right? So what can happen instead is when you have a moving average like the 50, you try to fine tune it a bit, lower it by 1, lower it by 2, lower it by 3, lower it by 4, right? Until you can find the natural moving average where price most closely is able to catch the bounces, and that will be your natural moving average, right? The natural moving average is always changing. I can show it to you over here, right? Let's see if I can show it to you over here, okay? Indicator, right? We're going to throw a moving average, right? And we are going to maybe tweak this to 200. Okay, look at this. 100 moving average. Price touch it once, go down. Price touch it twice, go down. Touch it 3 times, goes down, until it finally crosses it, goes up, right? So look at the bounce over here. Okay, this is the 100 moving average. What can we do? You know, at this stage over here, maybe you can see that you might have got faked out and crossed down before going up. Okay, let's see if we can tweak this a bit, right? So in this kind of case, right, when price is over here, right, I'll be saying looks a little bit fishy. 110. Nope. Maybe 120. Nope. 115. Maybe 113. Right. This could be a better indication for your moving average, right? So in this case, you can see how you are able to capture, you know, when you capture the tops over here more accurately, right? More accurately, it prevents you from being as badly wicked out previously than this. Okay. Now I do. You would not have noticed that, you know, it caught the bounces here nicer, and when the crossover happened, you know, it gave you a much better indication of price dropping, right? And if you're really trailing it, you know, you wouldn't get stopped out. You wouldn't get stopped out, right, all the way down. Of course, right? If you look at it here, right? So this is let's take a look here. You know, you realize that nice is right about there, right about there, right about there. What happens when you do at the 100 moving average? You can see on the 100 moving average, this part over here, right, is not as nice. You know, it actually closes below the 100 moving average, right? And you might have got stopped out unnecessarily, right? So it doesn't capture it that nicely, right? It's all about, so we got people asking like what moving average to use on a daily chart. The trick is to use a moving average that catches price. Use the standard 50, right? You got 100, we got 200, and then you fine tune it from there, right? You need to fine tune it to get the natural moving average, right? Let me show you some additional examples, right? Let me show you some additional examples over here, right? So let's just say, usually a trend. So I'm just trying to pick up the best example. Maybe you do the 200 moving average. Let's go for something like the 200 moving average, okay? Now, let's see, in this case, the 200 moving average, you know, you might have been able to trade it very nicely, right? Seeing how price, you know, reverse from there, reverse from there, reverse from there, right? Reverse from there. You will notice one thing though, when you're using the 200 moving average, I'm going to zoom in here. Look at how many times like price closed above the moving average, right? Close above the moving average, close above the moving average. If you were using a close above the moving average as your indication to get out of a trade, man, you would be in for a tough time, right? You will have closed out the trade here once, close out the trade here twice, close out the trade here 3 times, close out the trade here 4 times, because each time price closed over the moving average before dropping down, correct? So a natural moving average in this case, right? So in this case, if you use it over there, right, you would have, maybe you were saying that, okay, price reverse, right? And then you're trading from here. You think that price is gonna break up from here. You want to go long, but it goes down, right? It goes up again. You think it's going to go long, it goes down again, right? So you end up losing a lot of money when it comes to this moving average. But if you, with this data over here, with this data, if you were able to fine tune it, right? So let's do it like maybe 210. 220, 15. Yeah, 223 over here, right? So you can see how it, it caught the wicks there slightly better, right? I mean, it's still close above over here, right? But it caught the wick here nicer. And then this would have been your profitable trades, right? If you look at this over here, right? Price reverse from there, reverse from there, reverse from there, right? This would have been an even more profitable trade for you, right? All because, right, you fine tune your moving average, right? You fine tune your moving average to go from 200 to 223. I know it sounds a little bit unconventional that your moving average is not 200, not 100, not 50. But this is the trick to it. When it comes to natural moving average, no one ever told you that the market will obey only a 100 or 50 or 200 moving average, right? The market behaves however it wants to. It has its own moving average that it can use, right? It's up to you to find the natural moving average and use it to your advantage, okay? Now, we of course have a question from Kurt. How close does the price action have to be to the channel to be classified as a bounce, right? I think you were looking at this part over here, right? How close does price action have to be to the channel to classify as a bounce? Now, the thing about price action, right, is that I'm going to write the word out here. Price action are like essentially like almost like candlestick patterns, right? Price action only happens in the tick of the action, right? You need things to be going on for it to be considered price action, right? So only when the bar forms, right? Only when the bar forms, then you can consider that, yes, that's where price action has happened, right? How close does the price action have to be the channel to be classified as a bounce, right? Usually, right, it needs to at least touch the, what's the word for it? It needs to at least touch one of the parts of the channel, the lower bound or the upper bound, right? So it is important that it touch the channel. Okay, as that is when the key deciding point happens. But always take note that you don't need to be too strict on that rule, because when it comes to channel trading, right, channels are essentially trend lines and they're not that accurate, right? Why are they not that accurate? Is because of this. Let me see if I can show you an example over here. If I had a trend line, see, if I had a trend line from here, right, and from here, all it takes is for my price to move by a bit, and my ending point will be very different, right? So if my ending point is here versus my ending point over here, right, it all looks very, very different, right, based on my ending point. So trend lines, all it takes is just a little bit small movement, and bam, this is now now not a breakout. This is a breakout, right? So when you're trading with trend lines and channels, a channel, right, like I said, a channel is just two parallel trend lines. And the problem with channels is that they are a little bit unreliable, right? So, where'd they go? Yeah, the problem with channels is that it is a little bit unreliable. All right, so the channels are used more as a gauge, more as a gauge to know that, okay, price is moving up, it's bullish momentum, I'm looking for bullish reversal. Don't use it as the confirmation, right? Don't use it as the confirmation. It rarely ever works well. Okay, I hope that answered your question, Kurt, but if it didn't, let me know. I will try to answer it better. Okay, now, so there's another thing that I want to show you guys, right? Oh, sorry, right? Beyond the natural moving average is that, yes, if you tweak your moving average by a bit, you might be able to find a much more accurate setup, right? You might be able to find a much more accurate bounce or a breakout that can happen, right? So don't hesitate to tweak your moving average just by down and up a bit, and try to catch as many bounces and reversals as possible to improve the accuracy of your moving average. Okay. Now this is an example of having a double confirmation for your channel breakout, right? So usually you have a channel breakout, right? But this time you have a channel breakout and you have a moving average breakout. Okay, so you can see how price over here, it broke out from that level. So if it were to break a channel, and if it were to break a moving average, or rather a natural moving average, it goes from a low probability trade to a medium probability trade, right? So you can see how price really broke nicely from here. There we go. And price comes all the way down to here, right? And you can see how the breakout worked out very nice. But this is a double confirmation. It's called a double break. So it did not only break the channel, but it also broke the moving average. So that gives us additional confidence that, you know, the break is successful and it should drop very, very nicely, you know, which it did over here. So one of the tricks to do is, of course, you know, combine your channel breakouts, whether it is channels, whether it is moving averages, whether it is channels, moving averages, what trend lines, you know, those are things that you can, if you combine it, it's okay. So you can see how the drop worked out very nicely from there. All right. So now I do want to show you this concept of confluence. Okay. So this is a chart you can see over here. It's a channel. You know, you got 1 touch, 2 touch, 3 touch, 4 touch. Yeah, correct. Yes, the user channel more as a gauge. Gauge of the trend, you know, it's not just a, you know, it should not be used to confirm your entry. Okay, so your price action does not need to be that close to it, right? 5 touch, right? Yeah, it's doing good. This trend line is great, man, right? I mean, this channel is great. On top of a channel, right? So you're expecting prices to continue going up, right? And then you throw on a natural, I call it the NMA, natural moving average, right? So then we can see, you know, price bounce up quite nicely. So it is a natural moving average. You have a channel, you have a natural moving average. Okay, then you go down here, right? You have Fibonacci confluence. No, I mean you got an Ichimoku Cloud, right? Ichimoku Cloud showing that, whoa, there is not only a channel, right? There's not only a nice little moving average, natural moving average that's supporting price, but you also have an Ichimoku Cloud. So there are 3 reasons why you're bullish over here. Okay. And then you have the last one, which is your golden cross. You know, before this whole thing happened, you had the golden cross, which was a long-term sign that the short-term moving average, has crossed over the long-term moving average. When this happens, right, it's what we call a golden cross. That is a sign that price is going to continue rising for a long time. Okay, so we have the momentum of the golden cross, we have the momentum of the channel, we have the momentum of the natural moving average, we have the momentum of the Ichimoku Cloud. All of them combined, they give you a much a high chance of price working nicely in your favor. Okay, so you can see from here how price, you know, from here we are expecting prices to bounce up, right? We can see how price actually did touch this level. Right, this touched the level and did bounce up nicely as part of the whole concept of confluence. Because guys, you know, when it comes to trading, it's not only about using one thing. You don't just use channel and you trade. You don't just use Ichimoku and you trade. You don't just use moving average crossover, then you trade. You know, you don't just use natural moving average and then you trade. Right, you combine it all together, right, to give yourself the highest chance of getting the trade right. Right, it all comes down to a confluence of reasons, right? Don't trade a single strategy in isolation. Combine multiple of them together to increase your chances of getting a profitable setup. All right, guys. So there's one thing I want to encourage you guys to do. If you're here, right? I know Natalia, right? I've said it before, right? But I think, yeah, they are still preparing the landing page and stuff, right? Please go over to vip.ironfx.com, right? This is the link that I'm going to give to you guys. Right, vip.ironfx.com is a place where you can practice your analysis, right? I know we're officially not super duper launched yet, right? It's supposed to be launched within the next week or so, right? So that's why I haven't posted a lot of stuff in there. But when you're in here, right, the nice thing is that you can come in here when you register an account, you're able to actually ask me questions, right? So maybe, right, you are looking at euro dollar. You're looking at euro dollar and you're wondering, hey, you know, has this breakout has this breakout happened, right? And you know, is this a valid trend line? You can just come in here and say, hey, Desmond, right? Is this a valid breakout and also a valid trend, right? What's a valid breakout? Highlight this word, link object to text. You can select the object that you just drew. And what's a valid trend line? You highlight it, select link object to text, select the trend line, click confirm. You can send the message through. So how it looks like when someone reads the message like, hey, Desmond, is this a valid breakout? When they hover the mouse over it, they can see, oh, this was the breakout you were referring to, right? And this was a valid trend line that you're referring to. So I can say, all right, this is lit, right? I'm going to give it a fire, right? I'm going to view discussion. I'm going to have my own separate discussion over here, right? Saying that, hey, you know, maybe something like that. It looks like a cup and handle, maybe cup and handle, right? Highlight this, link it to whatever I just drew, cup and handle, send the message, right? This is the cup and handle that you're looking at, right? So it gives you a lot more opportunities to practice your analysis. Okay, so if you have an IronFX account, you will get access to it. You just need to sign up. All right. Now, all right. Let me see. I have covered most of my what we need to cover for today in today's webinar. Do let me know if you have any other things. Right, I am looking for some of you guys who want me to do some analysis. Right, I am looking at this particular movement here. Looks like a change in the trend. Right, this is how I do my analysis. You know, prices bounce up, bounce up, bounce up, bounce up. 1, 2, 3, 4 critical bounces, right? So when you have 4 critical bounces and this happens, you start to have a low-key kind of panic. Same time, you throw on the moving average, Ichimoku. It has crossed below the Ichimoku. One reason, right? 2 reasons why it might drop, right? For on top of that, right? This little swing low support broken, right? Might be dropping further. Another important reason that we might be looking at, right? Then we look at maybe the moving average, right? Nothing much in the moving average, honestly, right? It's not clear at all, right? But we have 3 reasons here, right? We got the trend line breakout, right? We got the Ichimoku breakout, right? And we look like we have like a support level breakout, so it could trigger a move down, maybe even all the way down to here. Okay. Now, guys, thanks for staying throughout this webinar to listen to the concept of using trend indicators, right, to trade better, right? Do remember, it's not about, right? It's not about just trading in isolation. It's not about just using the Ichimoku, using the trend lines, using channels, right? Using natural moving averages, using golden and death crosses. It's about combining them together, right? So example, in my example over here, in my example over here, right, it's a combination, right? It's a combination of not only the moving average, it's a combination of the Ichimoku Cloud, right? It's a combination of the, what is this called? A golden cross, right? It's a combination of the channel, right? So we got 1 reason, 2 reason, 3 reason, 4 reason, giving us nice little thumbs up, right? To confirm us that this is a nice trade and that you should maybe risk like 2% on the trade, right? So this, I mean, this is not financial advice, but this is what I mean by that. If you had 3 of the 4, maybe this is 1.5%. If you only had 2 out of the 4, maybe it becomes 1%, right? If you got only 1, right, then you don't trade at all, right? So that's the approach you should take to confirming the different trend indicators, right? Use it in your trading, right? Use it as confluence and confirmation all together, right? So Sonta is asking how to get recordings and other recordings of webinar, right? I'm going to send a link to you, right? Just head over to IronFX.com. Actually, I can go to IronFX YouTube, right? We can go to playlist over here, right? We can watch the webinar series, copy paste this, right? So you guys can go check it out. All the past webinars are there for you to go through. Okay. It has been a great time hanging out with you guys. Thanks for staying, Summer, Saunter, Natalia, Kurt, Ishmael, Gabe, everyone else, right? Thanks for staying throughout this entire webinar. I hope you found it useful in helping you be a better trader when it comes to trend trading, right? To open your perspective to the different momentum indicators out there, different natural moving average, how you can combine multiple things together to give yourself the best chance of being a profitable trader, right? So that's the key thing that I want to you guys to take note of, is that never trade a single indicator in isolation, right? That's why I gave you 5 indicators. Combine them together to give yourself the best odds of being correct. Okay. Thank you very much, guys, right? Stay safe, trade safe, peace out, right? Thank you, Natalia. I'm glad you like it, right? I hope you guys, the rest of you guys also like it, right? Do tune in for tomorrow for our live trading session. Thank you very much, Ismail, right? Kurt, yes, I think we got approved already, right? I just need to, I need to send it back to you. Good point. Thanks for the reminder. I'll get you access to the VIP room and the candlestick indicator. All right, guys. Thanks very much. Take care. Yeah. Thank you very much, Kurt. VIP room, summer goal, right? Is this thing over here where you can come in and you practice the analysis and you can get our exclusive, like high probability kind of research, right? To be good, that you can use in trading, right? So go check it out. I'm going to send you the link. Go register for a new account over there, right? Summer, go register for a new account over there. And as long as you have an IronFX account, you should be able to get access, right? Just remember, click on this thing called request access and let me know what is, send a screenshot of your account, okay? That's it for me, guys. Stay safe, trade safe, peace out. I'll catch you guys next week. No, I'll catch you guys tomorrow for our live trading session. It might be me, it might be Jin, it might be Cassandra, but I will let you know. Okay? Take care, guys. Bye-bye.
Hi everyone, Emily here. Today I will be talking to you about some crucial trading tips. 3 important qualities traders tend to ignore. Your personal life should complement your trading career. In other words, if your personal life is a mess, how can your trading be at a top level? You have to protect your personal life and keep your mind clean from outside interfering, as this could affect your trading. Second, you have to enjoy the ride. A successful trader knows how to enjoy his life on the rainy days and on the profitable days. That means if you reach an objective, let's say a profit target, do something for yourself or celebrate. If you failed, move on. Third and final, you must have a balance between your personal life and your trading career. Some traders think that by spending 16 hours per day in front of the screen or doing research, they will be successful. That is a no-no. You have trade, but you should also spend times with your kids, your wife, your family, your friends. So make sure you're chasing the right things. It may sound hard to trade and keep a full-time job at the same time, yet a number of part-time traders proved that this is doable and actually may prove quite profitable. We have a couple of tips for such a trading. First, be organized and disciplined. Make a plan. Target specific events. Have your technical and fundamental analysis well before the event takes place and stick to your plan. Don't forget to keep it sweet and simple. Secondly, use the technology given. Use the stop loss, take profit levels as well as pending orders and incorporate them in your trading. They tend to take lots of pressure off of you. The same applies for alerts, which inform you instantly when a particular trading instrument has crossed a particular level. I know it takes time to master this, but believe me, they are worth every minute of the time and effort spent. Thank you so much.